The IRS just dropped a massive alert for the 2026 filing season, and if you're planning to submit your return, you need to stop what you're doing. A brand new law, the One Big Beautiful Bill, has officially gone into effect, and it's completely rewritten the rules for your 2025 taxes. We aren't talking about minor tweaks. We're talking about a historic surge in refund amounts alongside aggressive new verification systems that could freeze your money for months if you make even a tiny mistake. Here is the reality. The standard deduction has jumped to record highs, and there are now hidden deductions for things like overtime pay, tips, and even auto loan interest that most people are going to overlook. But while the IRS is dangling bigger checks, they've also slashed their staffing by 25%. This means their new automated systems are doing the heavy lifting, scanning for discrepancies in real time. If your 1099-K data doesn't match or your child tax credit documentation isn't perfect, your return won't just be delayed, it will be buried in a manual review queue that is already backed up. You need to know exactly which new credits apply to you and which red flags are triggering immediate audits this year. I've spent the last 48 hours breaking down the new IRS guidance so you don't have to. If you want to protect your refund and get every dollar you're legally owed, hit that like button right now so we can get this critical information to every taxpayer before the April 15th deadline. Now that we've got your attention with those high-level alerts, we have to dive deep into the mechanics of what the IRS is actually doing behind closed doors, because this is where the real danger lies for the average taxpayer in 2026. You see, the internal culture at the IRS has shifted from a slow-moving bureaucratic machine to a high-speed data-matching powerhouse, and if you aren't prepared for how that change affects your specific filing, you are essentially walking into a minefield without a map. Most people think they can just pull their information together at the last minute, plug it into a software program, and wait for the direct deposit to hit their bank account within a few days. But that era of tax filing is officially over. The reality is that the new verification systems are designed to find any reason to pause a return, and once that pause button is hit, getting your money moving again is like trying to turn a freight ship in a bathtub. We have to look at the first major pillar of these changes, which revolves around the massive influx of third-party data that the IRS is now receiving from every corner of the digital economy. It used to be that the IRS relied primarily on your W-2 and maybe a few 1099 INT forms from your local bank, but today they are receiving a constant stream of information from payment processors, crypto exchanges, and even peer-to-peer apps that you might use just to split a dinner bill with friends. The primary reason this matters so much right now is the total integration of the new reporting thresholds that have been looming over us for a while, but are now fully enforced for the 2026 season. If you have any kind of side hustle, or if you sold even a handful of items on an online marketplace, you are now part of a massive data net. The IRS is no longer looking for the big fish exclusively. They are looking for consistency across the board. If your digital footprint shows that you received $5,000 in payments through a specific app, but your tax return only shows $4,000, the system doesn't just ask you a question, it automatically freezes the processing of your entire return. This creates a ripple effect because while you're waiting for a letter in the mail to explain the discrepancy, the interest on any potential underpayment is already starting to accrue. And your refund, which you might have already earmarked for a major purchase or a bill, is sitting in a digital limbo. It is vital to understand that the IRS isn't just looking at the total amount you earned, but also how that income is categorized. Many people make the mistake of thinking that as long as they pay some tax, the IRS won't care about the details. But that is a dangerous assumption to make in 2026. They are looking for specific classifications of income because those classifications determine which deductions you are allowed to take and which credits you might be trying to claim. When we talk about credits, we have to address the elephant in the room, which is the complete overhaul of the verification process for family-related tax breaks. For years, the child tax credit and the earned income tax credit have been the primary targets for identity thieves and fraudulent filers, and the IRS has finally decided to treat every claim with a much higher level of skepticism. This isn't because they think you are a criminal, it's because they are trying to stop the billions of dollars that leak out of the system every year through fraud. However, the result for the honest parent is a much higher burden of proof. You might find yourself in a situation where the IRS asks you to prove that your child lived with you for more than half the year, and if you aren't prepared with school records, medical bills, or a lease agreement that lists your dependents, you could be looking at a delay that stretches into the summer months. This is particularly stressful for households that rely on these credits to balance their annual budget. The stress of not knowing when that money will arrive can be overwhelming, and that is why being proactive with your documentation is no longer optional. It is a survival skill for the 2026 tax season. Moving beyond the family credits, we have to talk about the shift in how the IRS views the home office and professional expenses for the millions of Americans who have transitioned to remote or hybrid work models. There has been a lot of conflicting information circulating on social media about what you can and cannot deduct, and I want to clear that up right now because following bad advice is the fastest way to trigger an audit. The IRS has updated its guidance to be much more specific about what constitutes an exclusive business space. If you are working from your kitchen table or a corner of your living room that you also use for watching television at night, the IRS is explicitly stating that you do not qualify for the home office deduction. In the past, you might have been able to get away with a rough estimate or a close enough description, but now they are utilizing aerial mapping data and even public real estate records to verify the square footage and layout of homes when a deduction looks disproportionate to the reported income. It sounds like something out of a sci-fi movie, but this is the reality of modern tax enforcement. They have the tools to cross-reference your claims against reality in ways that were impossible just 5 years ago. This brings us to the issue of professional help and why the do-it-yourself approach is becoming increasingly risky for anyone with a situation that isn't perfectly standard. While tax software has become very advanced, it can only work with the information you provide, and it often lacks the nuance to warn you when a specific combination of entries is likely to trigger a red flag. For example, if you are a freelance contractor and you try to claim a 100% business use for a vehicle that is also your primary means of personal transportation, the software might let you enter it, but the IRS algorithms will almost certainly flag that as a high-risk entry. They know the statistical likelihood of a single vehicle owner using that car exclusively for business, and if your numbers don't align with the national average for your profession, you are going to get an automated notice. This is why having a human element in your tax preparation process, or at the very least a very sophisticated understanding of the current year's manual, is so important. You need someone who can look at your return through the eyes of an IRS auditor and say, "Wait, this is going to cause a problem." Another major change that is flying under the radar for many people is the new set of rules regarding digital assets and cryptocurrency. The IRS has moved the question about digital assets to the very top of the tax forms for a reason. They are no longer treating crypto as a niche hobby for tech enthusiasts. They are treating it as a mainstream financial asset class that requires strict reporting. If you traded, sold, or even used cryptocurrency to buy a cup of coffee in 2025, you have a reportable event. The myth that the IRS can't track decentralized transactions is officially dead. They have established partnerships with major exchanges that are now issuing 1099-DA forms, which are specifically designed for digital assets. If the IRS receives a 1099-DA with your name on it and you check the no box on your return regarding digital assets, you are essentially flagging yourself for an immediate investigation. It's a direct contradiction of a government document, and that is something the IRS takes very seriously. Even if the amounts are small, the act of non-disclosure is seen as a major red flag for other potential omissions on your return. We also have to discuss the reality of the IRS's current operational capacity because this is the part that affects your timeline more than anything else. Despite the infusion of new technology, the agency is still struggling with a massive backlog of correspondence and a shrinking workforce of experienced agents. When a return gets flagged by an automated system, it enters a queue where it must be reviewed by a human being. Because there are fewer human beings available, that queue is growing every single day. If you file your taxes in late March or early April, you are entering the system at the absolute peak of the bottleneck. This is why I am urging everyone to file as early as humanly possible. The difference between filing on February 1st and February 28th could be the difference between a 3-week wait and a 3-month wait. You want to be at the front of the line before the system gets overwhelmed by the millions of returns that flood in during the final weeks of the season. There is also a significant update to how the IRS handles identity verification for new filers or those who have changed their status recently. They have expanded the use of the ID.me system, which requires a live video chat or a high-tech scan of your government ID to prove you are who you say you are. While this is great for preventing fraud, it is a significant hurdle for people who aren't tech-savvy or who live in areas with poor internet connectivity. If you haven't set up your IRS online account yet, you should do that today, not the day you plan to file. Getting through the verification process can take several days, and if you wait until the last minute, you're just adding another layer of delay to your refund process. This is especially true if you've moved recently or changed your name due to marriage or divorce, as the Social Security Administration and the IRS systems need time to synchronize those changes. As we look toward the final steps of the filing process, we have to talk about the importance of direct deposit. It seems like common sense in 2026, but millions of people still opt for a paper check for various reasons. I cannot stress enough how much of a mistake that is this year. A paper check is vulnerable at every stage of the process. It can be delayed in printing, it can be lost in the mail, or it can be stolen from your mailbox. Furthermore, the IRS prioritizes electronic returns that use direct deposit because they require significantly less manual handling. If you want your money as fast as the law allows, you must use direct deposit. Double and triple check your routing and account numbers, because a single transposed digit will cause the bank to reject the deposit, and then you are stuck waiting for the IRS to receive the bounced funds and eventually issue a paper check, which can add 6 to 8 weeks to your timeline. I also want to touch on the emotional side of tax season because it is a high-stress time for almost everyone. The fear of making a mistake or getting a notice from the IRS can lead to filing paralysis, where people wait until the last minute because they are afraid to deal with it. But in 2026, procrastination is your worst enemy. The new rules are designed to reward the organized and the early. If you take the time to gather your documents now, use the verification tools available on the IRS website, and approach your return with a focus on accuracy over speed, you can significantly reduce your stress levels. Remember that the IRS is a machine, and machines follow logic. If you provide the logic and the data they are looking for in the format they expect, your return will sail through the system. It's when you provide incomplete data or inconsistent information that the machine grinds to a halt. Finally, let's talk about what to do if you actually receive a notice from the IRS. The natural instinct is to panic, but in 2026, many of these notices are generated automatically by the new AI systems and can be resolved quite easily if you act quickly. The most common notice you'll likely see is a request for more information regarding a specific credit or income source. Do not ignore these letters. The IRS gives you a specific window of time to respond, and if you miss that window, they will simply disallow the credit or add the income and send you a bill for the difference, plus interest and penalties. Most of these notices can now be responded to through a secure online portal, which is much faster than the old method of mailing in documents. If you stay on top of your mail and your IRS online account, you can handle most issues before they become major problems. I know this is a lot of information to take in, but the 2026 filing season doesn't have to be a nightmare if you are armed with the right knowledge. You have to be your own best advocate. Don't rely on luck and don't assume that how you've always done it will work this year. The landscape has changed, the technology has changed, and the rules have changed. But by staying informed and being meticulous with your preparation, you can navigate these waters successfully. Keep your receipts, verify your data, and file early. If you do those three things, you will be ahead of 90% of the other taxpayers in this country. We are going to keep monitoring every update that comes out of the IRS, so you don't have to spend your weekends reading boring tax code. We'll break it down just like this, so you always know exactly what you need to do to protect your wallet. This is about more than just a tax return. It's about your financial security and making sure that the money you worked hard for stays where it belongs, in your pocket. Make sure you've double-checked those 1099K thresholds and confirmed your dependent information one last time before you hit that submit button. It's the small details that make the biggest difference between a quick refund and a long, drawn-out headache. Stay diligent, stay informed, and let's make this 2026 tax season as smooth as possible.